Okay. Let's open this Finance, Audit and Risk Committee meeting. Declare it open. Are there any apologies? Councillor Pitahira, you may have to escape early. Just noting you may have to leave early. That's noted. Thank you. Public participation. I have actually received one item of public participation from Dr. Graham Lindsay. However, having read it, it is actually requesting Council do a number of things regarding the landfill. It's actually not an agenda item, and therefore, understanding orders, I'm not prepared to read out the public participation because it doesn't add in. It's not on the agenda, or the only thing that's on the agenda is we comment on some landfill costs. Nothing to do with, unfortunately, Dr. Lindsay's submission participation item. Late items, I'm not aware of any late items. Declarations of conflict of interest.
Yeah, thank you, Chair. Ordinarily, I would declare a conflict in relation to matters associated with the Horowhenua New Zealand Trust and Economic Development Services. But given this is an information paper, I thought I'd just flag it, but not actually formally step out of the meeting.
Thank you. Confirmation of the minutes of our meeting held on Zoom on the 25th of August. Can I have a mover? Thank you, Member Jackson. Do I have a second? Thank you, Councillor Todd. Any further discussion? All those in favour, please say aye. Those against, carried. Under announcements, we've got our Horowhenua New Zealand Trust, and welcome everyone. I think everyone knows everyone here, so thank you for your participation today. You can actually remove the masks. It can probably make it a little easier to understand, so that you're not garbled. Thank you. We've actually got a copy of your report, thank you, in the agenda, but I understand you've got a brief presentation. Thank you. The floor is yours.
I could probably start with. There you go. Ahi Marie. Good afternoon, everyone. FAR committee members. I'm Anthony Young, Chair of the Horowhenua Trust, and I'm with Katrina Mackay, our CE for the Horowhenua Company. First thing I'd like to say is thank you, Council members and HCC, for supporting economic development in the district. Small businesses, food producers, construction and building, and many more commercial entities are an important lifeblood into the community. And we know that job growth, improving household income, and investment by the private sector helps the wider community and drives economic and social outcomes. The report that our team put together, we've circulated, and it gives a pretty comprehensive overview of our economic development activity in the past 12 months. And I think delivers some really tangible outcomes for our district. And some of the highlights are listed there. They include attracting $3.8 million of central government investment in areas such as the Horowhenua Business Park and Get Go. And that's enabled us to have quite meaningful relationships and partnership with government agencies like Ministry of Education, Ministry of Social Development and MB. We've engaged 600 students with multiple employers in our Get Go Futures Day, and in fact received a lot of engagement. Our social media page has reached 130,000 people around Get Go. We've helped us secure $100,000 for local businesses through the Regional Business Partner Network. and have assisted a number of businesses in accessing grants such as through the Callaghan Innovation Fund. In the past 12 months, we've had 10 Electra BA5s. Those events regularly see between 60 and 130 attendees, in addition to numerous workshops with businesses. We've surveyed 169 businesses, mostly face-to-face or phone interviews, and to better understand their key constraints to business growth and their employee needs. And we have a newsletter that goes out to 1,120 recipients across the community, and with a high level of engagement. So the last email newsletter we sent out around COVID had a 49% open rate, which may not mean much to you, but having worked in the digital marketing world, where you're lucky to get 15% of people opening emails, 49 is a very good score. And the Horowhenua Business Park, we've just finalised the last purchaser of that last lot, and so we will house a dozen businesses, either new to the district or local businesses looking to expand. So lots of good things, lots of good highlights. And while the contract scope is all about focusing on how we can help the business community, I think what we've been able to achieve has been to encourage and get businesses to lean in as well. For example, Woodhaven hold a horticultural class with Horowhenua College students, and they set aside, JJ's done a really nice job, set aside some land where they grow crops, sort of mentored them to do that, and then they get to sell the produce. To Waipehu has a trades class that we've helped encourage, which Thermosash help us to run. And so we've seen them and the likes of Turks and Techlam and OG, Speldhurst, Genoese are willing to kind of invest quite significant time to open their doors to get those students in and more aware of opportunities locally. So some really nice stuff there that has been done. Shane Gorinsky, who runs GetGo, has been working with Spark to assist students at Manawatu College to get free internet access so they can study from home. So lots of areas where we're touching the community from an economic development banner, but also, I think, making really positive impacts. The BA5s, which I know a number of you attend, yes, they're good networking opportunities, but it's also been a forum for us to surface important issues to our business community. We had Louise Atkin, who's the CEO of the Akina Foundation, discuss how social and environmental responsibility isn't just the government or big corporate responsibility, that small businesses in our district can initiate and take that responsibility. And we had Shamabil Jakob kind of prompt discussion around affordability and housing. So stuff like that is kind of that combination of activity, I think is helping to contribute and helping us as a district kind of move things forward. Go to the next slide. This is, we're kind of encouraged by the data. This is sort of data over the last 3 years. Job counts are up 481 jobs in the past 3 years. So too is household income, and proportionally better improvements seen with Māori. So not all of our own doing, of course, but by HDC bringing a focus in on economic development, we are all helping to double down on supporting the business community that ultimately play a big part in driving these results. But as much as these results are strong and encouraging, we're still quite far away from where we need to be. So there's still a job to be done. It's still required, I think, commitment to economic development. Our income is still well below national averages, and we record the NEET rate, that is 16 to 24-year-olds not in employment, educational training. So that number's come down. So 21 16.2%, 16.9%, but that's still the second highest level in the country behind Otahuhu. So, we've got lots of work to do, and I think that's why we're encouraged that you've been committed to economic development and supportive of what we're trying to achieve. So thank you for that. We and through our operating arm, the Hora Whenua Company, remain totally committed to drive and build on these achievements and also involve the economic development in conjunction with your long-term plans, which we've taken very good feedback into. So, Katrina, do you want to talk to that?
Yep.
What we've got coming up?
Well, kia ora tātou. For those of you who I haven't met before, called Katrina Mackay aho. I'm very pleased. This is my first meeting anyway. So, my first meeting of the opportunity to come in and speak with council and the committee. So I've been in the role in the company for just over 2 months, and absolutely honoured to have the opportunity to provide service to our community in this way, and really believe quite strongly in the opportunity to bring sustained wellbeing through economic development. So I just wanted to very briefly talk about, and I'm very conscious that council earlier today considered the future contract, and congratulations for that decision. But just wanted to give you a little bit more about some of the areas that we're really focused on going forward in that new over the next just over 2 years, 2.5 years. First of all, we took quite a lot of cognizance of the refreshed economic development and implementation plan that council had undertaken, and considered some of the areas for increased focus that were evident through that work. We also took quite a lot of did quite a lot of thinking about this government's policy on economic development for regions, and how you can measure outcomes and impacts rather than measuring activity and inputs. And that's a real feature of what we'll be establishing, is looking at economic outcomes, at the data, at what some of the insights are, and what some of the impacts are for businesses and members of our community. We'll maintain our focus on activity measures. It's important for you to understand what it is that we're doing to generate the outcomes, but you'll be seeing an increasing focus on how we are making a difference for organisations. The other thing that we will be doing is starting to pick up on some of those areas that we can see through both the qualitative and the quantitative feedback that we get, where there are gaps in what at the moment. So one particular area of focus will be in working with our local iwi, Ngāti Raukawa, the Runanga, but also the individual hapu and local marae groups, and with more puku, to understand what their aspirations are and what a meaningful relationship could be in our supporting some of the achievement of those aspirations. I know that it's not something that we do individually. It's something that a number of you sitting around the table are quite collectively involved in, but we're quite committed to forming a relationship that's enduring and sustained, that achieves outcomes that are determined by what our iwi want. I'm also conscious that there are sectors of our community and our businesses that are not regularly featured in some of our engagements, thinking particularly about sort of our retail and our service industries, but also thinking about Foxton and what's happening up there as a consequence of some of the investments that have been made and the opportunity to generate more business activity up there. So I hope that gives you a bit of a taste of what we're looking to deliver over the next period, and really excited about the opportunity to continue to be a partner of council in doing that work, but to have that measure of independence that allows us to lean in on the areas that we see as needing that effort. Thanks.
Thank you, Katrina. A couple of closing remarks that I'd like to add about the trust itself. We're now 3 years old, and in that time we've evolved. We started it with the idea of an independent and accountable partner for HDC and economic development. We become a commercial property developer. We have set up a business and to talent connection service, and starting to take some role in the community. Our mission is to improve economic and social outcomes for the community and to find tools that can enable us to do that. And it's a model that we've developed very much as a collective effort, and with the support of council and HDC, trustees and the company employees all working together. Malcolm Alexander, who some of you may know, who was previously CEO of LGNZ, he joined us as the chair of our company. And one thing that struck me was I asked why would he want to join us, and he said he was really blown away with what is quite an innovative model that he sees of an independent organisation, but being totally accountable to providing services to you, and he wanted to be part of it. And Katrina had similar sentiments, and I've heard that sort of feedback from outside. So, I think we're doing something right, hopefully. I want to acknowledge Councillors Mason and Brannigan, who've been a kind of key channel for us, and through the governance group have really taken an interest in what we're doing and questioned what we're doing, and ultimately been quite supportive and shown some support. So thanks for that. Our appetite to bring better economic and social outcomes for the district remains high, and many exciting steps ahead. So thank you. Thank you for the time.
Thank you, Anthony and Katrina. Sorry, Andrew. The issue, I've written that, I got it right first time. On the agenda is your report, and maybe if the elected members or members of the committee got any questions, rather than debate them when we actually debate the report, now might be a good time. Or have you any questions? Councillor Ross?
Thank you, Katrina and Anthony, and welcome, and thank you again for the presentation and the fantastic work you're doing. Katrina, really great to hear you mention Foxham as one of the representatives up there. I think there is some fantastic opportunities for the trust up there, and some outcomes for our community that we look forward to having some discussions about. So, the question I had was around the NEAT. Have you got any background research to why that particular demographic is the sort of the lowest in the country? Is it what is the sort of background to that?
So I don't have there has been research done, and that was done in the Pathways piece of research that Martin Jenkins did. That was actually commissioned, I think, by council and about 5 years ago, and that identified that there was this really high needs problem for Horowhenua, and I think, my anecdotal assessment of it as part of it is that we have quite a high Māori and Pacific population of young people, and the opportunities that they see to have further training is to leave the district. A lot of opportunities for employment, a lot of the employment opportunities are seasonal, and so they just drop out of the system. They either leave the district, they just don't want to leave the district to go and do training or get work, so they just stay around and pick up little bits of work here and there. So there is research that sits behind it, but that's my recollection of the main features of it.
Thank you, and thanks for the work you're doing. Sorry.
Thank you. Any other questions, comments?
Bit of a left field question, but sometimes through long-term plan processes and annual plan processes, as well as through our grants committee, people put forward ideas and concepts that don't necessarily always sit well with council necessarily picking up that piece of work and running with it or funding it or backing it. And one comes to mind through the last long-term plan process, which was a motorsport park concept. And I just wondered whether these are the types of things, is this the type of thing that the Trust wants to hear about, or the Trust and the company wants to hear about, perhaps through our nominated governance representatives, or is there some other sort of mechanism that you have where people can put ideas on your agenda? I mean, what's your sort of preferred approach?
Well, look, we're just happy for people to approach us through the trustees or through yourselves. I mean, we have and are exploring quite a number of areas that we think we can make some difference and put back into the community. And it's part of the trustees' responsibilities to go out and do a bit of research and reach and talk to the community. But if you hear of any, and we've reached out to a number of you on that way. So, but we're open to exploring opportunities, either community ones or ones that could be both beneficially economically and community-wise.
Thank you, Chair. Look, it's just really a comment and a comment of thanks, because I was on council when we voted to set up the trust, and it was a big, I think, a leap of faith and an expectation that things would evolve in a positive way for the district, and they have. And I know that you have gone through iterations and changes and listened to what could be different. You've gone through quite a bit of community scrutiny, and particularly at your AGMs, where you've been open to all comers. So congratulations for withstanding that. And can I just comment that the calibre of the speakers you bring to BA5 is exceptional for this district, and on top of that, I've appreciated the relationship and understanding of how the Trust and the company are working, so thank you. But we're following growth really closely. You know, we've set some pretty significant targets in terms of, well, not targets, but has made some assumptions in terms of growth, and so that partnership with you on those economic dashboards are going to be critical in us for understanding how we're going and how the district's going. So I really look forward to that ongoing partnership and that information that will be coming through from you. So thank you.
Any other questions, comments? Thank you very much, Anthony and Katrina, for your time this evening. Thank you for your presentation. We'll just carry on with the announcements, and then we'll come back to the agenda unless councillors want to deal with this now. You happy to move it, are you, Councillor Jennings? Move the recommendation? Oh. You're happy to... Oh. Councillor David's happy to move it. Seconded Councillor Ross. Any further discussion? All those in favour, please say aye. Those against, carried. Thank you very much. We've now just got a sort of break while we swap presenters. We've got Miles O'Connor from Bancorp literally waiting in the wings. Outside, he'll be Bancorp, yes. And he's again got a presentation which is how long, CFO? How long?
About 35 minutes.
35 minutes. And while he's coming, is he happy to take questions, you know, as he goes, or at the end? Shall we ask him that? Okay.
I'd just like to hear Bernie's submission, actually.
Watch interrogate the
Welcome, Miles. Oh, we just. Oh. All right, Miles, the floor is yours when you're ready to go. Now, quick question for us. How do you want us to deal with questions? Do you want us to wait to the end, or are you happy that we interrupt?
Just interrupt, that's fine. Thank you, and thank you for the opportunity of presenting to you today. It's my first trip away. I usually travel every week. It's my first trip away since Tuesday when COVID was announced. When I think I was in Te Kuiti that day. But when I went into the Koru Club, and I'm in Christchurch, when I went into the Koru Club in Christchurch this morning, when I went in, I doubled the number of people who were there, the guests. So, but I think when I left, I made up about 20% of them. Things improved. But as I say, thank you very much for giving me the opportunity of presenting to you. Do you want me to quickly explain who I am and what we do? You're all right? So, my name's Miles O'Connor. I work for Bangkok Treasury Services. We advise clients on treasury issues, and our biggest sector is actually local authorities. We have about 170 retained clients around New Zealand, and of that, I think about 35 or 36 are local authorities. So we advise them on treasury issues, and that for a council, the two most prevalent ones are advising on funding. So that's how you get your money, how you get your funding, and then when you do get it, what form it comes in. Is it what maturity does it have? Is it floating? Is it fixed? And then we also advise on an ongoing basis the best way to manage your debt. So there are various things that you can do once you've already got debt where you can reprofile it to achieve a better outcome. The firm's based in Auckland. I'm in the Christchurch office. We have two other part-time employees in the Christchurch office, but in Bangkok Treasury itself, I think there's about 13 or 14. In Bangkok, we have close to 40, I think, employees. So we're one of the biggest, or if not the biggest, independently owned merchant bank in New Zealand. So our local authority coverage runs from Far North District Council to Invercargill City Council. So we've got a reasonably large spread. I mean, I've just been at Kapiti, and tomorrow I'm going to Manawatu and Horizons. So I'll go on to the presentation. Now, Phil, how long would you like me? How long? 20? 30? Oh, 20 or 30, okay. Now this has got a point, is that the, should be, is that it?
That's gone all,
Back. I just wondered if there's a laser pointer with it.
yeah.
That'll be it there, right? Yeah. But it's not working. No, okay. It's working on my hand, but yeah, it's probably not bright enough. Okay. What this chart is the United States, the Australian, and the New Zealand 10-year bond yields going back to 2019. Now you can see in the middle of the graph, you probably can't see it at the front table, can you? Oh, right. Back in August last year, thank you. So that's. Oh no, that's working. Yeah. So just a couple of key points here. This is back in August last year. New Zealand bond yields went down because the Reserve Bank came out and said that it was highly likely that interest rates would go negative in New Zealand. And so New Zealand bond rates went down and US and Australian yields went up. Now you can see that very sharp line going up there. That was November when the Reserve Bank came out and essentially dialed back expectations for negative interest rates because of the strength of the economy. So normally you can see we're reasonably closely correlated, but that correlation broke down then. We resumed that correlation, and then yields in all three jurisdictions went down. Now, that was really driven by US yields. Now, sounds rather unusual. It's a bit of a paradox. Why US bond yields were basically the benchmark for long-term yields around the world, obviously being the biggest economy. Now, the US Federal Reserve came out earlier this year and said that because of more persistent inflationary pressures, they were referring to inflation pressures as being transitory, because of more persistent inflation pressures, they believed that it would be necessary to raise rates sooner, their short-term rates sooner than what they had previously been thinking. What that actually did was push long-term yields down. Now, I know that sounds a total paradox, but what it is that short-term rates are governed totally by Reserve Bank policy, central bank policy, the Reserve Bank in New Zealand, the Fed in the US. But the bond yield is partially derived from what short-term rates are doing, but it's more a reflection of a return over the inflation rate. So by the Fed saying they were going to push up interest rates to curb inflation, that actually brings the projected inflation rate down, so it has the effect of suppressing interest rates or drive long-term interest rates, driving them down. So on the one hand, you've got the expectation that short-term rates would rise, but then that has the effect of pushing long-term yields down, because often we get asked the question, what are interest rates going to do? And I say to clients, well, there's a question within that question, because some short-term rates can go totally the opposite way. Sometimes they go hand in hand, but sometimes they can go a totally opposite way to each other. And that, I mean, in this particular case, it's called the yield curve flattening out. Now, you can see that in the last few months, though, that rates have gone up. That's once again a concern about inflation that's reigniting. But why New Zealand is not correlated, and why we've gone higher, is because there is an expectation that we're at a different stage in the economic cycle. Our Reserve Bank is almost certainly going to raise rates next week. So rates can be so there's an expectation that also inflation in New Zealand will be higher than what the Reserve Bank ideally require or mandate that they have to keep it between 1% and 3%. So that's actually a reflection that New Zealand is probably doing better than a lot of the rest of the world. And one of the main reasons is actually what's happening with employment, because you can see employment is it's above the rest of the world. We're back to 100 as where we were pre-COVID. And it's showing that we're actually above our employment levels that we were at in prior to March last year, whereas Australia and the US are both considerably lower. The US is, I think, about 8 million jobs short. So the Reserve Bank came out, I think Christian Hawkesby, the Assistant Governor, came out a couple of weeks ago and said that with our employment levels where they are, it's probably going to lead, it gave a pretty strong indication it's going to lead to a rise in short-term interest rates and the official cash rate. And the other reason that the Reserve Bank want to or see the need to raise interest rates is because of house prices. So the darker line is the actual house prices, and then the lighter line is the house sales. Normally, the two go hand in hand. Well, when you have a decline in the volume of house sales, it normally leads to a decline in house prices. This hasn't happened this time, so this is a bit of an unusual one. You can see that house prices have continued to rise. There's the big recovery from COVID. But sales have actually dropped. So this is, I think, probably confusing the Reserve Bank. It's confusing quite a few people. But it's probably driven by the fact that there is an awful lot of money stimulus in the system. There are foreigners coming in and buying. And it's also, there's a bit of a distribution around. I mean, some house prices are in certain areas are higher than increasing higher than others. What I've actually heard is that Auckland and Wellington people are buying in the South Island because they just see better value for money. But the Reserve Bank seem to be hell-bent on getting house prices down, or at least stopping the pace of house price increases. Now, it's interesting to note that the last time the Reserve Bank hiked interest rates, since the chart on that in a minute, in 2014, the amount of lending from banks to residential first mortgages has increased 60%. So that actually means that the Reserve Bank are going to get 60% more effectiveness, or a rate hike is going to be 60% more effective this time because there's 60% more debt. So they don't actually have to do as much as I think what a lot of people are actually expecting they will need to do to rein in house prices.
Sorry, Miles, can I ask a question on that in terms of the amount of household debt that has risen in the last maybe 2 years, especially in light of the amount of mortgage debt that's risen significantly, obviously. What pressure is that putting on our economy in terms of people's ability to be able to actually support that debt?
Yeah. At the moment, it's not too big a problem because as you said, our unemployment rate has remained reasonably constant. So, well, it's recovered back to the pre-COVID levels. So, people have still got the ability to fund a mortgage or to pay for a mortgage, but in Auckland, especially, with the house price and the amount of debt that's been taken on, it's not going to take much of an increase in interest rates to affect them, and maybe to achieve the Reserve Bank's aim of reining in house prices. But also, if the economy does turn down and if people start losing their jobs, it's one thing having a job and, okay, interest rates go up, you might be able to pay your mortgage. If we get that unemployment rate start to rise, I think that's when they've got serious problems, yeah. I mean, New Zealand at the moment, I think, is one of the house prices in New Zealand are some of the most unaffordable in the world at the moment. This is a chart I dreamt up a wee while ago. Well, the chart, I didn't dream it, but the chart itself I thought is it's interesting to see what's happened. So this shows that the official cash rate in New Zealand in red, the 3-month swap rate in the, the black, and the 3-month bank bill rate, and then the 7-year swap rate. The 7-year swap rate, I can't really see the colours on this one so well, but that's the 7-year swap rate. That's the official cash rate, and that's 90-day bank bill rate. So what we find interesting, if you find charts interesting, not everyone does, but when the Reserve Bank last hiked interest rates back in 2014, here's the official cash rate, and they started hiking there. You can see that's the 90-day bank bill rate, and that started increasing prior to it. So they preempted the move up in interest rates, the 90-day rate. Normally it trades at about 25 points over the official cash rate. But the interesting one is here. Here's the 7-year swap rate. So just think of that as a 7-year fixed term rate. That actually started preempting it about a year earlier. So what the markets actually do is that they preempt future Reserve Bank policy. And what had happened was that by the time the 7-year swap rate peaked here, and then it's just a little bit late, and then it started falling, and just a little bit later, the Reserve Bank started pushing up the official cash rate. So what it actually did was, as the Reserve Bank, and that's what I came back, that interest rates can go in different ways, the Reserve Bank are pushing up interest rates, and yet long-term rates are coming down. So what that is actually saying is that the markets preempt or front-run future Reserve Bank policy. So they're effectively a monetary policy cycle ahead. We were entering a tightening cycle, yet long-term rates were falling. And they continued to fall for quite a while. And you can see there that the Reserve Bank only had to hike rates 4 times and then they stopped. And we've got that much more debt that I was referring to earlier. So what is projected, the Reserve Bank and the markets are thinking the 90-day rate might get to the OCR around 2%. If this is anything to go by, it might not. But the interesting bit here is the parallel. Here's the official cash rate now, so it's flat. Here's the 90-day rate. It started preempting the rise in the OCR. It went up, and then it was the day before a Reserve Bank announcement that it was the day before COVID was announced on that Tuesday, and so that stopped the Reserve Bank from hiking the cash rate then, but now it's gone back up. So the 90-day rate has gone back up, but the 7-year swap rate has gone from about 0.25 up to 2%, so it's gone up about 1.75%. Now, the bit that I wish I knew, because if I did, well, actually I wouldn't be here talking to you because I know exactly where interest rates are going, but it may be that these long-term rates have actually reached their peak because, and once the Reserve Banks start tightening, now I can't say this with 100% accuracy as I said, but it is following the pattern that happened last time when the Reserve Bank raised the cash rate back in 2014. Are there any questions on that one? I think that's quite an important chart. It's quite a revealing chart too.
So what you're saying is based on the market, the Reserve Bank will hike. Do you think there's actually something that if Auckland stay in level 3, they might, because of the Auckland economy, they might just slow that down a bit because of the long tail of Delta?
No, I don't think they will. There was Christian Hawkesby, the Assistant Governor, came out last week, and was it 2 weeks ago, and said that with employment reaching the levels that it's at, then he gave a pretty strong indication that that the official cash rate will go up by 25 basis points next week when they have the next review of it. And I don't know what you're seeing, but from what I can see, the effect of this time, the effect of COVID hasn't been so dramatic on the economy as it was last time. And I think businesses have learned to adapt better, and there hasn't been the same hit from the economy. And also remember, there's been an awful lot of stimulus pumped in by the New Zealand government, well, the Reserve Bank, the New Zealand government effectively. So in answer to your question, Phil, I think they will go next week. So Auckland, I don't think Auckland being in level 3 still will affect it. They actually said last time, and after they didn't hike in August, they said it wasn't actually directly related to COVID. I mean, they said it was a matter of communication, and it was sort of people. They said it was a matter of it was a matter of communication why we didn't hike the OCR, and people couldn't understand what they actually meant. What I think he meant was that it would have been difficult to raise the cash rate the day after we've just announced the country going into a level 4 lockdown. I think that's what he was saying, but we're a bit confused by it. And actually, I better go through these a bit quickly. This is just expectation. This is expectations for the cash rate from the Reserve Bank, which is that line there. So that's what the Reserve Bank project the OCR to go to. So by November 22, 1.75, and the market, the latest projections from the market for it to be at 1.5. So they're not quite as optimistic as the Reserve Bank are. Well, what they're doing is they're front running the market. So here's the Reserve Bank, but here's the what the market is now thinking. So they think they'll be shorter and sharper than what the Reserve Bank are projecting. But that is where they were projecting at that dotted line back in March. So you can see there's been quite a big change. And just to show you the benefit or the lack of benefit, this is the market, and this is what the Reserve Bank's OCR projections were. So where the Reserve Bank have made projections, this is what their projections are at the various times going back to 2004, and the black line is actually where it went. So by then, the Reserve Bank thought it would be there, and it was there. The only time it got it right was when the cash rate didn't go anywhere. And actually, if you look at market pricing, that pretty much follows the same pattern. The only thing that's consistent is that they're normally wrong. Now, there is a saying about that, and I've got to get it round the right way. Why did God invent economists? To make weather forecasters look good. That's right. Yeah. So everything so I'm probably saying now that everything I've said about Reserve Bank projections aren't going to happen. It actually doesn't say much for my profession.
It's only what we've been thinking for many years.
You're probably wondering why you pay us money. um,
Are you funding Entity C?
Were you funding what, sorry? I didn't catch that.
Will you be funding Entity C in the Three Waters?
Oh, Three Waters, yeah, okay, that's another one. Yeah. Now, do you want me to go through this? Jacinta asked me just to give I did send, oh no, that's the next slide actually. This is just about LGFA. Are you familiar with LGFA, or do you want me to quickly go through how it actually operates? So those are the current LGFA rates that Horowhenua District Council can obtain funding from the LGFA Act. So how it works is these are the maturities here. Oh, this one's working now. Those are the maturity dates that no, it's not. So those are the maturity dates that the LGFA offered. So you can get any funding actually from the LGFA, anything from 1 month out to April 2037. This is the credit spread that it's issued at. Don't worry about that too much. But if you want it on a floating rate basis, these are the rates that you can get from 3 months out to April 2037. And these are the fixed rates. Now, there's been a big change in these because you can see that the fixed rates are considerably considerably more expensive than LGFA rates. I mean, just look at this one. I mean, 1.14 for April 27 compared to 2.27 for a fixed rate. Now, with the fixed rate, that rate is set for the life of the bond. So when you obtain fixed rate funding, the rate can't change. When you obtain floating rate debt with these floating rate notes, the maturity date can be the same as the fixed rate bond. The credit spread or the margin stays the same, but the rate changes in accordance with changes it's reset every 3 months in accordance with changes in the 90-day bank bill rate. So what this is actually saying is just follows on from what I said earlier, in that the markets are projecting that the floating rate will rise. That's why they're factoring it into the long-term rates. Into the long-term fixed rates, well, all of the long-term fixed rates actually. Funnily enough, back in August last year, when the expectation was that interest rates would go lower, those fixed rates were lower than the floating rates. So there's been a huge turnaround. Are there any questions? Probably quite an important slide in some ways. Are there any questions on that one?
So in 3 months' time, not 3 months' time, in the next 3 month interval, if you put this table up again, you'd expect to see that middle column with higher interest rates, right? Is that what you're saying? Because
yes.
Yeah.
And if what I said earlier about, if history repeats itself and those long-term rates have actually peaked, and when the tightening starts, then those fixed rates could actually come down. So again, that's the market's being a cycle ahead of the Reserve Bank. Interest rate risk management. So you've got 114 million of debt, 84 million is fixed. We've got 12 fixed rate bonds. You've got what we call a forward start bond, which is April next year, isn't it, Jeff? That it starts. We took the opportunity. April and May, yes, that's right. Yeah. So we've actually taken the ability. We've taken the opportunity to pre-fund some of your debt next year in case rates go higher. We did that a wee while ago when rates are actually lower. You've got 4 interest rate swaps now. Jacinta asked me a question about the use of swaps. I think there are some questions there around that. With interest rate swaps, what they do is they change floating rate debt into a fixed rate. virtually the same outcome can be achieved using a fixed rate bond, and that it fixes your rate. They can be to exactly the same period. Where we have the same outcome, or we want a fixed rate to a certain debt, if we've got the choice, and we do always have the choice, mostly we have the choice between using swaps, so you have a floating rate note and a swap over the top of it, or you have fixed rate debt. We use fixed rate bonds, and there are several reasons for it. Fixed rate bonds, this gets a wee bit technical, but if you do a floating rate note with a swap, or you do a fixed rate bond, and they're exactly the same maturity, the bond is somewhere between 5 and 7, so 0.05 to 0.07, 5 100ths or 7 100ths of a percent cheaper. And it makes a bit of difference, with a reasonable amount of funding over a long period. The other one, I probably should have put that in as the other advantage of it is that if you use a fixed rate bond, you don't have a mark to market on your swaps. But I think it was last year, early last year, I gave a presentation and compared your swap valuation with your peers around you. I mean, I think I used Capity, Palmerston North, Tasman, and someone else, and your mark-to-market loss on your swaps was way less than the other ones. I didn't do it this time. It's just because it'll be the June 20 figures, and we just about have the June 21 figures. So I thought, when I get them, I'll actually send it through.
Can I ask how much correspondence you've had with our former Chief Financial Officer around interest rates and where they're going and the swaps that we've got, and how much he pressured you into making sure that they increase over the next couple of years?
The previous one being
Doug.
Yeah. What, have I had any correspondence with him since? No. That's good.
You know what they used to say? Interest rates can't go lower.
Yeah. Oh, yeah. He told me Jeff told me that at his farewell, you did mention that you always said rates would go lower, and that came from me. Yeah. That we just, because rates actually fell. I mean, no one thought that the cash rate would go to 0.25. It was as a result. I mean, if you predicted COVID, then you would have predicted that interest rates were going lower. No one saw that. They did go lower, but before that, I think I can say with some degree of confidence now that they will not go lower. But that doesn't come with any guarantee. Now,
Can I just ask, in the future, Oz, will you be comparing us with Capity?
Capity have just become a client of ours in the last month. Yeah. So they did use our opposition up until recently. Right. Well, they used to use our opposition, I think.
They use in-house expertise.
We have, in the Treasury advisories. This is going back a few years, Jacinta. Yeah. This is going back a few years, not recently. I think they stopped about 3 years ago. So we have one main opposition in the Treasury advisory space. They're a small accounting firm, I think, called PwC. It's not a friendly relationship, actually. So, yeah. Did I answer that question? I can't remember. I got put off there. But now, sometimes exposures are difficult to manage without using swaps, because if we want to hedge what we call future exposures, you can do a swap starting in, well, I can do it any time from starting tomorrow out to 8 years or 10 years, whereas you can't do that with fixed rate bonds. We can do it up until the end of each financial year. The LGFA will let us issue these forward start bonds. It's just recently that we've done it. We did for another council, and actually Standard & Poor's rang up and asked what we were doing. And they actually liked it, so they actually thought it was rather a better way of pre-fund. Because what we've done in the past is pre-fund, where we've issued bonds. You don't need the money for, say, 6 months. We put it on term deposit, and you've actually made quite a bit of money out of it, but bond rates have gone up and term deposit rates haven't gone up to the same extent, so you can't make what we call a positive carry on it. The other thing about swaps is that they're more flexible. They're easier to close out. But as I say, I did put the mark-to-market valuation, so I didn't read further on. I can't remember what I wrote 2 days ago. You do have those mark-to-market valuations. So when we are looking at your requirements for fixed rate debt, and what we have done is that we have increased the level of fixed rate debt that you've had going back over the last 6 months or so in expectations of rate rises. But as I stress, if there's ever a choice and the outcome is roughly the same, we'll always use a fixed rate bond. And managing the interest rate risk, so you use these hedging parameters and they're broken down into time buckets, which are on the left-hand column, and then we have percentages, minimum fixed rate amounts and maximum fixed rate amounts that you can have in each of those time buckets. So you can see 0 to 2 years, 45 to 100, and then 25 to 80, 0 to 60, and then 0 to 20 for 8+ years. And how that works. Now this gets a wee bit complicated, but what we're showing here is the grey area is your fixed rate debt, is your debt, total debt, 114 million. Those red lines are your policy bands that I just mentioned. So there's out to 2 years, that's at 45%, that's at 100%, then there's 2 to 4 years, what was that, 25 to 80, then here 4 to 8, which is 0 to 60, and then 8+, 0 to 20. So you can have a minimum there and a maximum up here. And what the green and the blue are, the green is your interest rate swaps, and the blue is your fixed rate bonds. You can see we've got more fixed rate bonds than we've got interest rate swaps, and up here is the total amount of fixed rate debt. The dotted blue line is actually the underlying debt, so that's not how much is fixed or floating, it's the actual, and that can either be commercial, it's a mixture of commercial paper, floating rate notes, fixed rate bonds going out to April 29, isn't it, Jacinta? I think it's the longest dated one. So the key line here is actually this green one here. That shows the level of fixed rate debt. So that's using 114 million of debt. So that just shows that you've got reasonably high levels of cover, and as I said, we have increased them. Now, what we've just started looking at, and we haven't sort of reached a definitive decision yet, I don't think, but I can be corrected. Here's your debt looked at in a totally different way, and that's your projected debt. So, and we can use it under the terms of the Treasury policy. It's deliberately flexible. You don't, I think it's defined, the level of debt that you use, so that grey area instead of being 114 is going up to, I think, 15 million. So, and that's going out to September 31. It actually shows, though, that given the reasonably high levels of cover, even with your debt nearly doubling, you're still within policy and you're comfortably within policy. So I'm actually quite happy with that, because with the debt going up that much, you've still got reasonable levels of fixed rate cover. Now, the key question, and this is actually very important, that level of fixed future debt is as determined, I think, by the corporate services. What's your title, Jacinta? Yeah. Group financial. Yeah, sorry. Was it? Yeah. Chief Financial Officer. Yeah. The Chief Financial Officer, in conjunction with the CEO, you can actually determine what the level of future debt is.
So just to quickly mention here, the grey that you see is effectively the long-term plan debt that we set. And in that assumes that there's 15% of the capex, as we assumed in the long-term plan, that wouldn't happen in any given year. So the first year, 15% won't happen, but then it'll catch up each year. So this view here, we sort of, in talking with Miles, we set that level of where we wanted that blue line to be, or the green line, so that we had a reasonable amount of fixed debt given where interest rates were. And we're at 2.53, I think, at the moment, but giving us some room to make allowances if the CapEx program changes from where we think it will be.
Where councils have come unstuck on their hedging, and I mean there have been ones in the paper, is where they projected future levels of fixed rate debt but based on the LTP, which I think most people know are never achieved. I mean, I think local government New Zealand have come out and said that councils typically achieve 70%, I think it is, of their future debt. So they base their future debt and their hedging levels on the debt that was projected in the LTP, and they hedged highly. Now, what actually happened in reality was that they didn't achieve the debt levels and interest rates fell. I mean, they fell up until November last year, and they fell very, very sharply. I mean, they fell from since the start of the GFC, basically for over 10 years. So some councils actually had more fixed rate debt, fixed rate hedging because they had swaps, than they had debt. And that's where all of the negative, adverse cost of funds outcomes, that's how it happened. And I mean, they've been in the paper. Tasman was one where they had 108% of their debt covered. Luckily, none of them were advised by us, because that small accounting firm did it. Are there any questions on that? And that's your actual the debt. Now this is a wee bit confusing. The previous chart was the amount of fixed rate debt that you had, but this is your actual debt maturities, because that debt can be, well, fixed rate is achieved through swaps or fixed rate bonds. You've also got commercial paper and floating rate notes. This is the maturity profile, so this is when the debt itself actually matures. So what it's showing is, just based on dollar amount, and the bank debt is your bank debt facility for 10 million, which you don't use, and then it's either LGFA commercial paper, which is there, and then there's floating rate notes, and then there's the fixed rate debt. So it shows your debt maturities going out to 29. The good part about this is that you have a reasonable amount of floating rate, fixed rate debt, so that's going to, and that was done some time ago to protect you against rising interest rates, which are actually happening now. So you have a reasonable spread of debt maturities out for the next 8 years. We don't go out much beyond 2029, 2030. If you saw those rates that I put up earlier, they start to get too expensive. And we don't believe that rates will go up to the extent that the market's actually projecting at the moment.
Miles, can I just ask you a question? It's a big issue, debt for us. If 10 is perfect with the profile that we've got, where are we on the 1 to 10?
Is that for the...
If you look at the profile that you...
Is it that one or this one? Is it that one?
Just your gut feel as to how we've got ourselves positioned for the long term. Is there any room to improve, or are we absolutely got it spot on?
Oh, I mean, the only way that you have actually got it, the only way you would have got it spot on is if we had absolutely no cover, but we would have been breaching the Treasury policy because that stipulates how much fixed rate debt you have, is if we had absolutely no cover, and up until, was it the 5th of November last year, and on that day we fixed your debt 100%. That's the only way it could actually work. So, I mean, as I say, we don't know where interest rates are going, and no one does. But as far as your profile goes, I'm actually pretty happy with it, because you've got probably higher levels of fixed rate debt than a number of our clients, and how you've been going is reflected in that cost of funds. So there's always room for improvement. We actually did have one client who, they, a smallish council, they had 15 million of debt. They were going to join the LGFA, they decided, and they weren't a client of ours, then when they decided to join the LGFA, they took us on. They didn't have any, in the expectation of joining the LGFA, they didn't have any fixed rate, cover using swaps. They just happened to get all their debt from the LGFA back in the last week in October last year, and their cost of funds is 0.82%.
So just going back to my question though, because we rely so much on you, out of a 10, are you giving us a 10 with everything that we know?
I mean, no, a 10 would be, with the benefit of hindsight, then I would say probably I would mark you about an 8. What we are doing is, I think did I mention it to you, Jacinta? We're bringing out a cost of funds for various, I think we've got about 30 clients, and putting it in a scatter graph. But it's not attributed, so there's no attribution, but you'll be able to see where you are. I mean, you're not at the bottom, but there are a whole lot of factors, or probably not in the bottom quartile. You're at 2.54, well, the range is 0.82, and some go over 4. So they're not all our clients. Some we've just inherited recently. Well, it shows how you are relative to your peers, and it also shows the debt levels. But there's a whole lot of reasons why they can be different. And one of them is when you get your debt, because it just happens that if you get like this one, or South Island Local Authority, when they got that one in October. So that was luck. That was just pure luck. But I think you've got a pretty attractive cost of funds, and I'd say an 8, and there is your cost of funds.
One thing just quickly as well, we will be going hopefully back to Standard & Poor's in November. They did say to us that if we did look at improving our liquidity position, which we've done with those forward start bonds that start later, that will pay for all the debt that becomes due over the next year, that from a liquidity perspective, hopefully, that may put us in a position to move towards an upgrade. They did ask us to come back and see them early if we'd shown that we'd made that improvement, so hopefully.
So that's AA, so going to AA minus. I mean, that's one thing that Standard & Poor's, so I'm probably mindful of time, I'll just make it very quick. I don't agree with Standard & Poor's on that need to pre-fund future debt. They place a huge reliance on it, so we have to do it for other clients, but I don't agree with it. We've had discussions with them about it, because what they say is that you have a risk in the future around your ability to attract funding. Well, to me, that's nonsensical, because you get your funding from the local government funding agency. The LGFA has a Standard & Poor's AAA credit rating. It's the same as the New Zealand government. It's held up around the world as one of the most successful examples of a local government funding vehicle that there is. Mark Butcher is actually, I know, was it last year or the year before, he was speaking to both England and Australia about how they can set one up, because it's been so successful. It's based on the Nordic models, and I think the Norwegian one is recognised as being the most efficient. So the LGFA has $1.5 billion, all these safeguards, $1.5 billion of liquidity from the Debt Management Office. It has over $1 billion of funds invested. It has these borrower notes from you. It has unpaid capital. There are so many. I could go on and on about this. I disagree with it. Fitch, actually, if you're with Fitch Ratings, they don't assign that same importance to it as S&P do. And I just think that they're wrong. The S&P are wrong on it, but they do use it. So if that's going to determine your rating, then we have to abide by it, and we have to do what they want, because the most important thing is for you to get the best credit rating. Yeah, because it was banks or it was the bond market. Yeah. I mean, you have actually got I was talking about it, another council the other day. You can actually switch to Fitch if you want. The only problem with it is that you don't know what credit rating you're going to get. And so if you wanted to find out how much it would cost, what credit rating you get, it would cost you $50,000 to find out. Yeah. I mean, I think you would get a better rating from Fitch. I think you'd be at least AA minus. But you might be going to that with S&P. That's it, I think. Oh, sorry. There was one last one. One last slide. That's actually your cost of funds projection. So actually, Brian, that's probably quite a good graph to look at. Your cost of funds so this is the projected cost of funds, where it will actually go. It's not working properly. This is forward looking, but it's actually showing that cost of funds will decline slightly over the next few years, and that's when you've got higher price fixed rate debt maturing. So I'm running out of time now, so. Thank you. Pleasure.
Sorry, Jacinda, I assume that Miles' presentation will go on the hub? Yeah. Thank you.
Thank you. Pleasure.
Thank you. Sorry. Our next item is on page 27, the Project Steering Group Update Report. Councillor Christine, do you want to talk to this or move the recommendation with assistance of the Chief Executive and his team?
Yep, thank you. So I'll just talk to it briefly, if you like. So this is the first report that we've brought forward to the FARS agenda, although it's probably the third meeting that we've had. So the Project Steering Group is basically an opportunity for some governance people, elected people to actually meet with officers, mainly the infrastructure